Today, I want to discuss a new exciting stock that many people have concerns over the underlying thesis. Now, if you're worried that AI is going to kill off SaaS companies, then this could be the video for you, because a lot of investors are concerned. And honestly, they're right to ask the question. AI agents are replacing software workflows. The old way of doing things is being dismantled fast. But here's what the skeptics are missing. Not every single SaaS company is sitting there just waiting to be disrupted. Some of them are working towards being the disrupting. I'm Lawsy. I run the OptionsBrit, where I talk about investing, the UK ISA strategy, and how I use options premiums to fund my stocks and shares ISAs and SIPs. And I want to talk to you today about one company I am genuinely most convicted on right now. ZETA Global. This is my foundation stock at the moment. I'm buying it in my ISA, in my options portfolio, and in my retirement accounts. I'm buying the dips, and I'm going to show you exactly why, including the bear case, because I think if I'm being honest about risk is what separates a real investor from someone just shouting about their bags on social media. Let's get into it. So first things first, what actually is ZETA Global? ZETA Global is a US listed company on the New York Stock Exchange. The ticker symbol is ZETA. They describe themselves as the AI marketing cloud. At the time of recording, the stock is sitting around about $17 with a market cap of just over $4 billion. Now, what does an AI marketing cloud actually do? In simple terms, ZETA uses artificial intelligence and one of the largest proprietary consumer databases in the world to help big enterprise companies find new customers, to keep existing ones, and spend their marketing budget more efficiently. That's the key to ZETA. They have data on 245 million US individuals permissioned for online tracking, 110 million for email. That is proprietary data moat that you simply cannot replicate overnight. And it's that data combined with AI that makes their platform so powerful. Now, if we look over here, I'm using a site called Stock Unlocked. I'll put the link in the description. It gives you so much detail and it grades the stocks for you. So for beginner investors, it's absolutely ideal, okay? You can see from this chart here, we've got down here a 52-week range with a low of 1069 and a high 2490. The range is currently sitting slightly more towards the 1069. So we're looking at the lower end here. So for me, this is in a really good buy-in spot. But let me show you why before I get ahead of myself, because there is a bear case and we are going to address that head on today. And I'm going to try and talk you through why I think it's negligible. So before we move over to the charts, just down here, you'll see we have got a grading system where Stock Unlock grades. Now, if you just take a quick look at this card at 3.21 out of 5, you'd be forgiven for just moving on from this stock, right? But there's a bigger picture here. Two of the main factors that I look at here is look at that growth. 5 out of 5. It doesn't get any better. Analyst ratings, 5 out of 5. These metrics are all measured on data from the financials and the balance sheets, which we will take a quick look at in a second. But the main thing to realize here is that the main bear thesis is based around stock-based compensation. The company has historically paid its employees and executives in shares rather than cash. The bears will tell you ZETA is giving away the company to insiders, and for a while, they had a point. The second bear case is gap profitability. ZETA hasn't been consistently profitable on standard accounting measures. EPS has been negative. For a lot of traditional value investors, that's a red line straight away. Those are two legitimate concerns, and I'm not dismissing them, but I'm going to show you my take on them. Okay, so let's talk stock-based compensation concern properly. What you're looking at here is revenue versus stock-based compensation plotted side by side over time. This is where the bear case for me starts to collapse. Revenue going from 591 million in 2022 up to 729 million, 1 billion, and now 1.3 billion. That is a 30% compound annual growth rate, or 121% total growth over 3 years. However, the blue bar here is the stock-based compensation. It was 299 million in 2022. It's now 178 million, down 40% in total, shrinking at nearly 16% per year, while revenue is growing at 30% per year. And the Q4 2025 earnings data that really hammers this home. Stock-based compensation as a percentage of revenue improved from 19% in 2024 down to 14% in 2025. The company is actively buying shares, $121 million in buybacks in 2025 alone. Management is explicitly addressing dilution because they know it's the bear case and they're acting on it. Now we're going to move on to the profitability question. I'm just going to make a few changes to the chart over here. And we will now be able to see the free cash flow position. So Q4 2025 was the first quarter that ZETA posted GAAP net income as a public company, 6.5 million. That's not a big number yet, but the direction that this travels in is clear. And the CSO has guided for full year GAAP profitability in 2026. That's huge if we can make that. Completely wipes the bear case and it puts us back on the front foot. Free cash flow in 2025 was $165 million, up from 39 million in 2022. That's a huge 61% compound annual growth rate and a 320% total increase over 3 years. This company is generating serious real cash and accelerating. Now let's come back to the open question. Is ZETA a SaaS company that's going to get eaten by AI? I want you to think about this properly, because the companies that get disrupted by AI are the ones that use static software workflows. They build a tool, you click through menus, it does one thing. An AI agent comes along and it replaces it entirely. ZETA is not that company. ZETA's entire platform is built on AI. It was AI native before AI was fashionable. Their data moat, 45 million consumer profiles, becomes more valuable with AI, not less. You can't train a better marketing intelligence model without better data. And nobody has the data that ZETA has. But here's what really makes the AI bull case. In January 2026, at the CES, or the Consumer Electronics Show, ZETA announced a strategic partnership with none other than OpenAI. Not just a loose integration, a deep collaboration to power their new product called Athena. Now, Athena is ZETA's super intelligent marketing agent. You talk to it like you'd talk to a colleague, ask it questions about your campaign performance, tell it your business objectives. It gives you answers and executes actions. It is literally AI replacing the manual work of enterprise marketing teams. And the CEO, David Steinberg, said on the earnings call, and I want you to hear this clearly, that Athena is designed to become the operating system of their clients' lives and business. Not just a marketing tool, an intelligence layer that sits across the entire enterprise. We are the disruptor, not the disrupted. AI is moving from the edges of marketing to the center of how enterprises operate, and Athena embodies that shift. The OpenAI CCO himself said of the partnership, ZETA shows how advanced AI moves beyond insight and into action. This isn't a company bolting AI onto an old product. This is a company that was built for this moment. Onto Q4 revenue. 395 million, up 28% year over year, excluding acquisitions. Full year 2025 revenue was 1.305 billion, up 30% year over year. That is the 6th consecutive year of 20% or more revenue growth. Adjusted EBITDA for the full year, 279 million, free cash flow 165 million, with a 61% compound annual growth rate since 2022. The big thing here is that net revenue retention at 128%. That means that they already have customers that they are introducing new products to who are spending more money with them year over year. That, for a SaaS company, is insane. This means that customers are spending 28% more with ZETA year on year. Super scaled customers. Their biggest accounts grew 24% year over year to 184 companies. 9 out of their top 10 verticals grew more than 20%. This was the 18th consecutive beat and raise quarter. That means every single quarter for 4.5 years, ZETA has beaten its own guidance and then raised its targets for the next quarter every single time. 2026 guidance has been raised to 1.755 billion in revenue. That is a 35% growth. EBITDA guided to 391 million, 40% growth. Free cash flow guided to 231 million, which is a 40% growth. And the long-term ZETA 2028 target is now 2.3 billion in revenue. David Steinberg has said publicly he intends to lead ZETA to become a $10 billion company. That's roughly 2.5x the current market cap. When a CEO with an 18-quarter beat and raise track record says that, I'm listening. And not only that, look at this. The analysts, they agree. 20 analysts, 0 sell ratings, 0. 80% are buy or strong buy. Average target is $30.86. That's a 77% upside from where we sit currently. High targets are $46.20. Bank of America has a target of $30. D.A. Davidson, $29. This isn't retail hype. These are institutional analysts. Now, here's the part that I think is genuinely underserved in the UK investing content. I hold ZETA in my stocks and shares ISA. For anyone watching who's new to this, a stocks and shares ISA is a UK government-backed tax-free investment account. You can put £20,000 a year per tax year. Any growth, any gains, completely sheltered from capital gains tax forever. So when I think about ZETA going from $17 towards $30 or even $40 or even higher as the business scales, every single penny of that gain inside my ISA is tax-free. That is massive structural advantage that most British people are either not aware of or not using. Here's my personal approach on top of that. I fund my ISAs through options trading. I'll sell options contracts on US stocks and collect that premium. The cash that generates that goes into my ISA to buy more ZETA. I'm not just relying on my salary to build this position. I'm making the market work for me to compound my stake in a company I genuinely believe in. That's the complete system. Options premiums, funding an ISA. ISA holding a high conviction AI native growth stock with 18 consecutive beat and raise quarters, an OpenAI partnership, and a CEO targeting $10 billion. That's not a gamble. That is strategy. So let me wrap this up and let you know exactly where I stand on this. For me, my fair price target for ZETA currently sits at $30. But I want to be clear about what that means. That's my conservative floor. That's based on analysts' consensus. And assuming that the company essentially stops growing, which we know it won't, as the business grows, my goalposts will move with it. This is a long-term position for me. It's not a short-term trade. The bear case, stock-based compensation dilution and gap profitability, both are real concerns, but both are directionally improving. Stock-based compensation is down 40% on revenue and falling. First gap profit posted in Q4, 120 million in buybacks in 2025. Management isn't ignoring these issues, they're fixing them. The bull case, 18 consecutive beats and raise quarters, 30% revenue CAGR, 128% net revenue retention, an OpenAI partnership powering an AI agent that could become the operating system of enterprise marketing, and a CEO with a $10 billion vision and the track record to back it up. 0 analyst sell ratings, remember that. Now, I'm a British investor. I hold this tax-free ISA. I buy the dips. I'll try to cover major developments on ZETA as they happen. If this is the first video of mine that you've watched, I'm Lawsy. This is the OptionsBrit channel. I talk about options trading, UK ISA strategy, and investments. Hit subscribe if you want to follow the journey. I'm on X at OptionsBrit. I post every time I add trades, especially on ZETA for the position. Come find me in the community there. Next earnings are around April 29th. I'll be covering major developments as they come. This isn't financial advice, just OptionsBrit brilliance. I'll see you in the next one. Bye for now.